Hello, everyone. My name is Lauren Adams, and I'm a certified financial planner and co-managing partner here at the center. It is my pleasure to welcome you today to our annual investment event, where you get to hear the center's latest thoughts on the markets and the economy and what it means for your portfolio and financial plan. Did you know that the center now serves clients in 40 states? Well, we recorded this presentation as a webinar that will be going out to our clients all across the country. And we hope many of you are listening in from a warmer location than us here in Southfield, Michigan. Well, no matter where you are, we're all glad you're here. You may be brand new to us, or perhaps you've been a client for 30 years or more. You're all important stakeholders for the center, and we wanted to share a few updates on the latest happenings at our firm before we dive in. First and foremost, the center is celebrating its 40th anniversary serving clients this year. We are commemorating our anniversary with in-person and virtual client appreciation events in September, so keep an eye on your email inbox for invites. We are also thrilled to honor this big year with the launch of a team-authored book on financial planning titled Finding Your Center: Achieving Confidence Through Financial Planning. We cannot wait to tell you more about it soon. As we enter our 40th year, the center now serves over 1,000 families and manages over $1.8 billion in assets on their behalf. We have over 30 team members, and we spend a lot of time focusing on workplace culture because we think happy employees translates into a better experience for our clients and also allows us to attract top talent to our firm. Speaking of top talent, we boast 15 certified financial planners now, meaning half of our team holds this gold standard credential in the financial planning world. Since our founding in 1985 by our three founders, Dan Boyce, Marilyn Gunther, and Estelle Wade, we are now on our second and third generation of ownership and count 7 partners among our ownership group. With that quick center update, now let's turn to our main event. First, you'll hear from our feature investment presentation, and then you'll have the chance to hear from one of our senior financial planners who will talk about some important legislative updates affecting the financial planning world. Now, I'd like to introduce you to our keynote speaker for today, partner, chief investment officer, and CFP professional herself, Angela Palacios. As chief investment officer, Angela chairs the firm's investment committee, which is made up of senior financial planners and portfolio managers at the center. She leads our investment department, who is responsible for everything from account trading to investment research. She was recently named a notable woman in finance by Crain's Detroit Business. Welcome, Angela Palacios.
Thanks, Lauren. And I'd like to thank everyone for joining us today. We are going to be discussing what occurred in markets last year and looking ahead at our outlook for 2025. I'll also do a quick economic and, of course, political update. And after that, Michael will join me for some financial planning updates. I'll put my contact information up on the last screen. So if you would like to reach out with additional questions afterwards, you can. So let's dive in. This time last year, we were talking about how the economy had avoided the most anticipated recession ever. Election years tend to be positive, so most experts were expecting a good year, and multiple markets delivered, as you can see here. Overall, a diversified portfolio of approximately 60% stock, 40% bonds, was up nearly 9.5%. Definitely above average performance and certainly above any financial planning assumptions that we make. The S&P 500 had a particularly good year, but again, this was driven by a handful of stock positions related to AI or artificial intelligence that you'll hear me talk about. If you remove the Magnificent Seven from that 25% return, the S&P was only up about 10% last year. So much more in line with small company and international stock positions. It's pretty interesting to think back through the headlines of last year with 2 assassination attempts on President Trump, 1 candidate stepping out of the race, and a virtual unknown stepping in. So while these headlines created a little short-term volatility, it doesn't show in the end numbers. Bonds had also a very strange year last year. They started out the year strong in anticipation of the Federal Reserve cutting rates, but as the Fed started to cut rates, it became obvious that they have achieved what they were looking to achieve, lower inflation and full employment, with far fewer cuts than the market had priced in. They ended up cutting rates by 1%, and we saw this flow through to our short-term investments like short duration bonds, money market rates. But on the longer end of the curve, longer duration bonds actually went up. This meant that bonds had a negative ending quarter of the year, finishing with nearly flat returns last year as longer term rates rose when the Federal Reserve was cutting those short-term rates. So what isn't on this chart is gold returns for last year. Gold had a fantastic 2024. Why? Demand from emerging markets like China, India, and Turkey certainly played into it. Geopolitical unrest means people drift into gold as a safe haven asset. We've had a change in retail preferences. Right now, there's more interest in gold than silver as it's trendy again. Costco even jumped on the bandwagon and sold small gold bars online and select stores, and they couldn't keep them in stock. There's also a delayed recency bias where inflation is fresh in our minds. What people don't realize is how volatile the price of gold actually is, as much so as stocks. You just don't get a monthly statement on your gold bars you bought from Costco. Not to mention the cost to sell them if you ever need to convert them to cash. So looking at returns for a year like last year can make investing seem a lot easier in hindsight than it is. This chart is an important reminder of that. The market isn't always all sunshine and rainbows. Even in a year like last year, when the price return of the S&P 500 was 23%, we still had one point in the year where we were down 8% from the prior peak. These mini pullbacks happen every year, sometimes several times a year. That's completely normal. It's likely we will experience this as well this year, maybe even a few times. I would expect it. On average, we have about a 14% pullback each year. I think people are often surprised to see this is normal. We anchor on those positive returns when we look back in hindsight, but forget about the volatility that does happen each and every year. This is the exact same chart, but with bonds instead of US stocks. I want you to take a couple of things away from this chart. One, what an anomaly 2022 was. You can see this negative bar here. While there had been rising rates and down bond markets before, as you can see in history, it was never to this extent. So don't anchor on that year when it comes to your opinion of bonds. Two, it shows most years how much less volatile bonds are than stocks. Average intra-year decline is only about 3.5% for bonds versus stocks at the 14% we just talked about. So stocks are compensating us for that added risk, but you have to hang on for the long run. Layering in lower volatility of bonds can help make stock volatility a little easier to stomach. We'll discuss this more in depth later. That's what I call negative correlation, which simply means that bonds usually rise when stocks fall. Now let's flip over from the markets to the economy. Throughout 2024, we saw inflation continue to subdue. Goods were the major source of reduction as shelter and services actually remained elevated in their inflation numbers. More recently, we have seen these two areas starting to subside as well, which should continue to help this year. Right now, we're still seeing the crunch, literally, in eggs due to bird flu supply complications. Car insurance is also pretty sticky inflation, and airline tickets are also leading the way in driving what inflation we do have. 3 years ago, most inflation was coming from new and used car prices. I'm sure you remember. Now those are actually detracting from inflation as prices continue to come down and are starting to level off. Unemployment has crept up a bit, as you can see at 4.1% there at the end of 2024, but it's still looking very strong. Trade deficits continue as per our norm. Did you know that we have been running a trade deficit since 1976 consistently? This is mostly due to oil. Good gross domestic product, which is the sum of all goods and services we produce here in the US, has been running stronger than anticipated as well. And that's mostly due to consumer spending. So speaking of GDP, I think it's interesting to zoom in on this for a second, just because we've seen some strength here recently. This chart breaks down where GDP comes from each quarter for the past few years. Growth has been normalizing since COVID, as you can see, as the GDP numbers have come down more into a normal range. But we've had still revenge spending that continued since COVID. So you can see this light blue area here is by far the biggest contributor in all of the quarters looking back, and that's consumer spending. That's you and I going out and spending our money. You can see the purple, which is the trade deficit, contributing negatively, a little stronger, especially over the past few quarters, because some of that's in anticipation of tariffs that are coming. We'll talk more about those later. So households are strong. Our debt is a much smaller percentage of our disposable income than it was pre-COVID. So it would take something pretty big to derail this portion of the economy. So heading into 2025, what can we expect from markets? I'm going to share some of my opinions of what I think most likely, but a crystal ball is hard to come by. Luckily, regardless of what I'm about to tell you, our planning work we do with you accounts for most curveballs that markets could throw at us. The major news lately has been the Fed, as we spoke about briefly earlier in this presentation. For 2025, the Fed will likely not be center stage, as we see very few cuts happening this year because there's been such good news for the economy. Likely one rate cut will come this year, maybe two, but probably not much more than that. The good news here is that we can continue to earn a decent interest rate on our cash. Markets will instead be paying attention to economic growth and corporate earnings, not to mention policies coming from Capitol Hill. But after 2 years of strong returns in tech, and thus US large company stocks, many are left wondering if that will continue. The dot-com bubble is still fresh in our minds, even though that was 25 years ago now. While valuations aren't as high as they were then, they are still higher than normal. What's different now versus then is earnings are much stronger. Back then, all of the returns were driven purely by price speculation, whereas today, yes, valuations are high, but they're supported by strong margins. Look at the green line on this chart. Profit margins in the tech sector are nearly double now what they were back then. Couple that with a pro-business president, and you could make a strong case that this bull market continues. AI is a force that we can't ignore as well. Right now, I think the biggest risk to earnings related to AI-driven improvements are certain bottlenecks to the next step of this revolution, energy being one of those bottlenecks. For example, an AI search using ChatGPT takes anywhere from 10 to 25 times more energy than a simple Google search. The more we replace our normal internet browsing with AI usage on a day-to-day basis, the more energy we're going to need. We're already at a point where the grid in the US is stressed at times. So AI searches also use a different type of product to run. You might be hearing more about agents in the future. Internet infrastructure just needs to be rebuilt at this point in time to move forward. And that's what some of those so-called Mag 7 companies are doing. This requires all sorts of inputs like chips, Remember, we've had shortages there in recent history, but you simply can't ignore adding the equivalent of a magic wand to your life. I've longed for this ever since I read my first Harry Potter book. But maybe that AI is a bit overhyped in the moment, but very likely underestimated in the long run. Being overhyped means it could be sensitive to bad news and negative performance in the short run after such a strong run up the last couple of years. We saw this late January when China announced they have a cheaper AI product. NVIDIA alone was down almost 20% in just that one day. So I think this year investors are likely to appreciate bonds again for the stability that they can provide when stocks decline. For example, when the S&P 500 dropped 8% from mid-July to early August in 2024, the Bloomberg U.S. Aggregate Bond Index posted a 2.6% gain. While there are no guarantees this will happen again, it's a good reminder of the important role high-quality bonds can play as part of a diversified portfolio. Also, the Fed has ample return to cut rates if a growth shock occurs or recession risk looks like it's escalating. Those rate cuts can help lead bonds to appreciate and offer diversification from equity market returns. Historically, periods of rate cuts have led to strong returns for high-quality core bonds since bond prices rise as yields fall. You can see the anomaly we lived through the last couple of year period and that we're now starting to resume a more normal behavior in bonds than they exhibited in 2022 and 2023. The dark blue line you see on this chart, the bar, shows when the S&P 500 is down, and the light blue bar shows the performance of bonds when those equity markets are down. So you can see that offset happening in all of those years, but 2 years, in 2022 and 2023, when they were both down together. So yes, stocks pay off more over the long term, but how much are you willing to gamble in any given year? The answer is different for everyone and something that we can help you figure out for your specific situation. This chart is another view of the benefits of diversification. This is just a simple portfolio of the S&P 500 and the core bond index. It shows that the bottom portfolio, that's 100% stock here, has the highest average returns of 12.9%. But it's also the highest volatility of returns, both up and down. So if you look at how wide your outcomes are, up as much as 38% in a given year versus down as much as 37% in a given year. By adding bonds in these 10% increments, you can see how you reduce that waistline of your portfolio, cutting down the range of potential outcomes, essentially. But it's also important to remember the limitations of data like this. There's no further diversification in this chart beyond U.S. large company stocks and the bond index, when in reality, there's a whole world of possibility to add diversification benefits beyond even this chart. And that's what we are here to help you with. So next, we have to talk about politics. We have a new political administration to keep our eyes on and how this may affect our portfolios over the coming year or two. No doubt there are going to be changes. There already have been many. Regardless of which side of the aisle you sit on, you can see that President Trump came in ready this time. I think back to 2016, he didn't really think he was going to win, I don't think, and may have been a bit surprised by how the political game works in Washington. I think this time we've gotten a person that's much more prepared than he was the first time. He had 4 years to figure out a vision and a plan for execution, and he came in ready this time with a staff of people he assumed were experts surrounding him. Overall, I think he is viewed as one of the more pro-market presidents that we've had. I think we'll see him trying to push for a reduction in corporate tax rates, possibly from 21% down to as low as maybe 15%, better energy infrastructure, and deregulation. While this doesn't guarantee good market returns, those potential changes create tailwinds for corporations here in the US. That being said, I'd like to remind you to expect it to feel a lot like the Wild West again in delivery. It's likely you'll see those tax cuts from 2017 that were supposed to sunset at the end of this year likely get put in place permanently or at least extended. So right out of the gate, we saw him cracking down on immigration. This could affect industries like agriculture, construction, or hospitality as they're losing workers. I think this will continue to remain a focus for 2025 for the administration. He's taking a strong stance trying to lower the price of oil. If successful, even by a small amount, this would help keep inflation on the lower side and potentially offset rising costs from any tariffs that get put into place. He has also long been a supporter of cryptocurrency and will likely to continue to put pressure on the Securities and Exchange Commission, the SEC, to start putting some governance in place surrounding cryptocurrencies. This is difficult though, because our economy is built on banks, and the banking industry is known to be very slow to adopt new technology, as we've seen. For example, the other day, I asked my bank if I could sign something electronically, and they told me I had to come in to do a wet signature, which in today's day and age seems strange. If they can't figure out electronic signature, how are they going to handle a virtual currency is something that I wonder. But let's spend a few minutes on tariffs, since that's been a major headline in the past few weeks. I think we will see some new tariffs put into place, even over and above what has already happened. And we will certainly see this being used as a bargaining chip for the president to push his agenda items like tackling the trade deficit and immigration. This slide shows the average tariff rate on US goods imports over time. Globalization has led to more relaxed trade policies, with tariffs declining steadily since the 1930s. However, recent geopolitical tensions and COVID-19 disruptions have prompted a reassessment of open trade policies, and tariffs sit at the center of the Trump administration's policy agenda. So calculations actually from the Tax Foundation suggest that if implemented as proposed, the average tariff rate on US imports could rise all the way back up to 17.7% in 2025, up from 2.4% in 2023. So how does this affect our market outlook? We don't think all those tariffs that are threatened here will be put into place, but it will be somewhere in between where we were then and where we are going, where the highest potential is. While tariffs would be hard on the US consumer, they will be much harder on overseas businesses and consumers. The president knows this, and that's why it's a particularly good tool to use to get what he wants, at least for now. More tariffs could impact inflation, moving it higher again, meaning the Fed may be forced to leave rates higher this year and would create some headwinds for international and possibly domestic investing too over the coming months and years. Goldman Sachs had their economists weigh in, and they think that if all those tariffs are put into place, it would increase inflation by about 0.5% from where we are now. So inflation numbers just came in yesterday showing January we're up to about 3%. That means it would boost it up to about 3.5% from where we are today. Remember, that would only happen for 1 year though, as in the future, you would be starting from that higher base next year when measuring inflation. So it should only be temporary in the sense that it would show up in the inflation numbers, not in the sense that impacts our consumer costs at the stores. Those costs are sticky and don't usually go away after they're in place. It could impact the strength of the US dollar, and it could impact companies' bottom lines. Certainly, it will create a lot of headlines, so expect that. What I would encourage is not to overreact and make sweeping changes to your portfolio because of these headlines. We'll certainly experience a whipsaw effect where we could see very negative headlines on one day with the market down, followed the next day by euphoria because of a different headline or a retraction of yesterday's headlines. So another concern I've heard recently is about who actually owns our government debt. You may worry if someone like China could have a major impact on our economy if they decided to sell all of their bonds that they own, as an example. This graphic does a great job of explaining that. The blue area, which is the largest area by far, shows that most of our debt is owned by domestic owners and government themselves, or groups like mutual fund companies, individual investors, pension funds. So while a country like China only owns about 2% of our outstanding debt, still a lot, but maybe not as much as you were thinking before. There continues to be people willing to buy the debt, especially here in the US, as consumer cash holdings are still at all-time highs, and we're looking for the best place to earn interest. As long as we continue to be willing to buy, the government will be able to continue to issue debt to finance the deficit. Many were worried about the Fed reducing its balance sheet these past few years and what that would do to our bond supply. The Fed has successfully unwound $2 trillion of debt, and it was largely like watching paint dry. So they're nearing the end of their planned unwinding now, so we should see this taper off completely in the first half of the year. In spite of so much headline noise, you can see that returns this year, at least for the month of January, and this has continued into February, have started out nicely in positive territory. Performance has broadened over other areas of the market beyond just a few of the top companies in the S&P 500. Just to put into perspective how dominant returns have been from those top companies, also called the Mag 7, from 2019 to 2024, 45% of the total return of the S&P 500 has come from just those 7 companies. That's over half the return of the market for that time period. So it's nice to finally see other types of companies experiencing more of a robust boost in prices. That makes for a much healthier market, less susceptible for short-term shocks. So what are some key questions that we're focusing on for 2025? Here are some items that our investment committee is sure to be discussing and thinking about. 1, will layoffs accelerate, affecting the strength of the consumer and thus driving GDP growth, companies' bottom lines, and market returns? So right now, the consumer has been strong, even though unemployment has crept up a bit. Wealth has become increasingly concentrated among large corporations and affluent households, which typically hold excess cash, getting a great interest rate still. As a result, they're likely able to bolster the economy with continued spending, offsetting weaknesses from those layoffs. But that only works for a while, I think. So if layoffs are continuing to accelerate, that could be what tips us into recession. I don't think that's our most likely scenario, but it's certainly something we're paying attention to. How about, will immigration reform drag on the economy? This is hard to quantify how much immigrants factor into our economy. Certain industries could be losing cheaper labor and have to pay much more to attract domestic workers. Think farming, construction, those types of industries. So we could see some food or building prices increasing, affecting our inflation numbers, forcing the Fed to keep rates higher for longer. The third question we're thinking about are even traditional economic indicators. Are they less predictive now than they used to be? There's been a shift in the U.S. economy away from manufacturing to services, as we've seen the last few years. We wonder if that's rendered kind of more traditional economic indicators like the Conference Board's leading economic index, less effective in predicting economic trends. These indicators have been signaling contraction for some time now, much longer than normal in a normal contraction. Yet the economy has continued to expand, as you saw earlier. So it's been completely driven by the services sectors. So are these measures no longer measuring the right things in our economy? So we have to always be questioning, are we looking at the right things to make decisions? Could there be shocks to reset how pricey some companies are trading? This is a great example of this is back in January, when that Chinese company released their cheaper AI I mentioned earlier. It sent NVIDIA in a nearly 20% pullback in a single day. So yes, I think there could be some vulnerable companies out there, but I'm leaning more into the fact that market performance is broadening out. And if that continues to happen, it should mute some of these Mag 7 companies' impact on the markets overall. So I always come back to the question of, what does this mean for our portfolios? If we think of it from the highest level of asset allocation, meaning how much do we allocate to bonds or US large company stocks or international stocks? That's what I mean by strategic here. We are working on lightening up a little bit on our international investments. This is an area that, because of the factors we've discussed, like tariffs, they could face some headwind. In turn, because of more protectionism, we like US companies, and in particular, medium-sized US companies. They aren't as exposed to interest rates being higher for longer like smaller companies are, but they stand to benefit from more protectionism and less global exposure in general. I also think our bonds are going to behave like bonds, meaning if stocks are negative a quarter or a year, they would likely perform better and be that ballast a portfolio needs during that time. Now we're doing some more tactical thinking too. For example, extending duration on our bond portfolios. You're now getting paid more for an intermediate term bond than you are on your short-term bonds. Plus, they offer more negative correlation or diversification from our stock positions. Lastly, we're always doing the things kind of under the hood in your portfolio, like rebalancing, tax loss harvesting, all those little details you need to do to keep portfolios doing what it is they should be doing for your financial plan. So in close, I want to let you know that we appreciate that you've entrusted us with this important work for you. We take this very seriously in both good markets and in bad markets. This is unchanged over the 40-year history of our firm. We've helped hundreds or probably well over 1,000 clients accumulate and plan for a variety of goals and life transitions in all types of markets. And we will continue to be here for you. Now I'd like to hand things back over to Lauren to introduce Michael to discuss some financial planning items.
Thank you, Angie, for sharing that analysis of where we've come and what might lie ahead. As center clients, you'll have the opportunity to hear from Angie throughout the year through newsletters like our investment commentary and timely videos to get the latest takes on the financial markets. So the focus of today is on the investment landscape, but hopefully you've learned by now at the center that we don't believe investments can be viewed in isolation. It is the combination of investment management plus financial planning that ultimately delivers the great results. And there have been some important updates on the financial planning side of things. I'd like to introduce you to one of our partners and senior financial planners, Michael Brocavich, to share these updates on how we expect they may or may not affect clients. Michael has a long track record in the advising space at various financial services companies. Do you remember earlier when I talked about how a great workplace allows us to attract top talent? Well, Michael was a partner at another financial planning practice, but ultimately was attracted to the unique workplace and mission that we built here at the center. He decided to join us in 2021, and we were very excited to invite Michael to become a partner last year. He serves as our Director of Financial Planning, in addition to working directly with clients as their advisor. Welcome, Michael Brocavich.
Thank you, Lauren, and thank you, Angie, for that tremendous financial update. So what I want to talk to you a little bit about today is just to give you some updates on what's going on out there and that might affect your financial plan, as well as some updates that may affect some taxes out there for individuals. So first thing I would like to start with is there has been a little bit of change to our Social Security. Now, for most of us, this won't affect our Social Security that's being received. But there are some folks out there that have had their Social Security either reduced or eliminated due to the windfall elimination provisions and the government pension offset. So most of those folks that have had these reductions are federal employees or railroad workers. But due to a new bill that was passed at the end of the year, recipients can expect to receive payments for those reductions and also back pay for those reductions going back to January of 2024. So that could mean some additional income for retirees out there this year. Now, moving on to Secure Act 2.0. So over the last couple of years, we have always spent some time giving updates on Secure Act. I'm sure you've heard it from us multiple times. But I always want to make sure that we understand provisions that are affecting us today and some Secure Act 2.0 provisions that are coming down the pipeline still. So one thing that's started this year that's going to be unique is some additional catch-up contributions for individuals that are currently adding to their work retirement accounts. So previously, we know that for individuals that are over the age, that are age 50 or older, have the ability to contribute more to their retirement plans. Traditionally, that additional amount has been about $7,500 that they've been able to add. Well, now for individuals between the age of 60 and 63, you have an additional catch-up amount, which means instead of the normal $7,500 that you've been able to contribute, you can now contribute up to $11,250. Another really nice provision that has come from the Secure Act 2.0 is something that allows us to do something with additional money that we may have in 529 plans. So what we are now able to do is do Roth conversions from 529 plans. So if you have a student out there that has excess money in their 529 plan, they may be able to convert that money into a Roth IRA in their name. Now, you can convert up to $35,000 over your lifetime. There are other rules that you will want to make sure that you understand before going forward with this. And you'll also want to make sure that you understand how state tax may be affected with this rollover. So even though converting a 529 to Roth will be free of federal taxes, your state may still have you pay state taxes on that conversion. For folks in Michigan, you would have to pay Michigan state tax on any Roth conversion from a 529. Another provision of the Secure Act 2.0 that has been continuously getting delayed is that high income earners will have to start to have their catch-up contributions. So those are individuals age 50 and over. So we'll have to have their catch-up contributions go to a Roth account in their work retirement plan. So this provision has continued to get delayed. It has been delayed again until 2026. So it's nothing that we have to worry about this year, but it could be something that individuals that make more than $145,000 will have to worry about next year. And we will continue to give you updates on that. Next, another provision that allows individuals to get more money into Roth accounts. Employees can elect employer matches as a Roth contribution. So if you are an employee that's contributed to the Roth side of your work retirement plan, and previously your employer's contributions have always gone into the pre-tax side, now if your employer allows they can make those contributions to your Roth account where you are already contributing. So again, it depends on if your employer allows it, but that is a provision that exists now going forward. Lastly, another good way to get more money into Roth accounts for our individual business owners out there that have SEP IRAs or contributing to simple IRAs. You can now have a Roth portion in a SEP IRA or a simple IRA when you contribute, which is different than what we've experienced in the past. Another provision of Secure Act 2.0 that we always want to make sure that everyone understands was the changes to the required minimum distribution ages. For folks out there that were born in 1950 or earlier, you've had to start your required minimum distributions either at age 70 and a half, some of you maybe at age 72. Well, now, if you were born in 1951 to 1959, your required minimum distribution age has been increased to 73. And those of you that were born in 1960 or later, you get to wait till age 75 before you need to start to take these required minimum distributions from your retirement accounts. The IRS realizes that they've moved this around a little bit, and it's moved around over the last couple of years. So they understand that there could be some confusion. So they have reduced the penalty for individuals out there that miss their RMD because they're may be confused about when they need to start. So what used to be a 50% penalty for missing your required distribution has been reduced to a much more reasonable penalty in case you do miss that. Now to get to a little bit more of a tax update. As a lot of you know, that there has been, over the last few years, there's been a few states out there that have experienced some disaster. So one example currently right now is the folks out in California that are victims of these wildfires. So individuals that are currently in a disaster area as considered by FEMA at the end of 2024, well, the IRS has agreed to extend your filing deadline, so you won't have to worry about trying to get everything in by April 15th. If you are in a current disaster area, you have the ability to extend that to October 15th. Obviously, with all tax advice, you definitely would want to check with your personal tax professional to make sure if that applies to you or not. Another nice provision that recently came at the end of December for those individuals in disaster areas, but not just for 2024, but have been in disaster areas from 2022 to 2024. So a lot of individuals in Florida and Georgia and some of the southern states that have really suffered losses due to hurricanes. Previously, when you go to deduct losses from a disaster area, you were limited to only being able to deduct up to 10% of your adjusted gross income. That has now changed where there is not the 10% rule, so you would be able to deduct more. That deduction currently right now is up to $22,000. But again, you're going to want to check with your tax professional to see if your area qualified as a national disaster area, and if you can deduct more for those expenses that you incurred, you may have to refile some of your returns from previous years. That refiling could get some people some tax return back in the mail. Another thing from the IRS to help individuals that are worried about people stealing identity or individuals filing tax returns on your behalf. One thing that they have come up with is a PIN. So you can file for a PIN with the IRS, and this will be an individual secure PIN only to you. And so going forward, no one would be able to file a tax return under your Social Security number without also providing this PIN. You can go to the IRS website to be able to obtain your PIN. So this could be something to help individuals out there that are worried about someone filing a tax return upon their behalf illegally. Another important provision that recently came out is if in the past you have used your refund to purchase I-bonds. I-bonds were very popular a couple of years ago, especially when inflation rates were up near 9%. People were using their tax return to be able to purchase I-bonds. The IRS has now stopped that, so you can no longer use your tax refund to purchase I-bonds, but you can continue to purchase I-bonds directly from the Treasury Department at treasurydirect.gov. Another provision that I want to make sure that people understand, because we've seen with some of our clients confusion out there in regards to the EV credits. A lot of individuals don't really understand or realize that these EV credits are based on income. And so higher income individuals may not qualify to get that EV tax credit. Those tax credits can be as high as $7,500. And there are dealerships out there that will give you the tax credit in advance, thinking that you're going to qualify for it, making your purchase of your vehicle a little bit cheaper. And those individuals are realizing when they go to file that they're not in fact getting that tax credit because their income, if you're married filing jointly, is over $300,000. Or for individual EV buyers out there, if your income is over $150,000, you may not qualify for those tax credits. And then lastly, a new provision. I know a lot of individuals out there for some side income like to sell things online. And previously, we never really had, if you just sold a little bit here and there, you may not have to worry about actually paying taxes on what you're selling online. Well, the threshold for online sales has been reduced pretty significantly. So now all you need to do is sell $5,000 or more online, and whatever you use, whether it's eBay or any other type, Etsy, or any other type of service that you use to be able to sell your goods and services online. If you sell over $5,000, they will now send you a 1099-K. Which you will need in order to file taxes. Lastly, what I want to touch on is in 2023, there was a bill in Michigan for the Lowering Michigan Cost Plan. And I just want to remind individuals, because folks are going to start to see reductions in the state taxes that they pay on their retirement income. So that's income from pensions and income from IRAs and 401ks, 403bs. So those work retirement accounts that individuals have been adding to their whole lives. 2025, now more of that income for retirees will now be deductible. So up to 75% of that income will now be deductible. So retirees out there should see some lower Michigan state taxes. In 2026, everybody will be able to enjoy full deduction of that retirement income. Now, there is one exception to this for individuals out there that are either local police, local firefighters, EMS, if you're an emergency telephone operator. Those individuals out there, they automatically are eligible for the full deduction. So there isn't the age phasing in for them. So if you are a retiree and you held one of those positions before you retired, likely you're currently right now not having to pay taxes on that retirement income. So that's all I have for today. I'll bring it back to Lauren to close us out.
Well, thank you, Michael, for that timely overview. I know many of our clients have been wondering about the new laws and how they will likely affect them. Our team of planners is looking forward to addressing how the investment outlook and the actions coming out of Washington, D.C. that you heard about today will affect you personally when we see you next. Thank you all for spending time with us today and for your continued trust and confidence in all of us at the center. We'll see you soon.